The hypergrowth telehealth company HIMS and Hers is one of the most volatile stocks in the market today. In the past 6 months, the stock has gone from $25 in the beginning of the year to $70 in February and then back to $25 in April. And now the stock is back to about $50 a share, rallying by more than 100% in just 3 weeks. A handful of positive news like its partnership with Big Pharma Novo Nordisk, as well as strong Q1 results, catalyzed the recent rally. So, with the stock now up more than 100% this year alone, is HIM stock a buy? Well, that's what we're going to cover in today's video. I'll be talking about the company's recent Q1 results, some of its recent news, and what that means for the company. And of course, I'll discuss the company's current valuation and what I think about the stock moving forward. Full disclosure, I do have a position in HIMS. In fact, it is my largest holding by far. And if you're interested in following my portfolio, you can do so by signing up on Savvy Trader, which I'll leave the link in the description box below. Also, in the description box is a link to my most recent article on HIM stock, which is pretty much the article version of this video. So you can check that out down below. And with that being said, let's take a look at the company's Q1 results. Firstly, let's take a look at the company's growth. Subscribers, which is arguably the most important metric because it is a leading indicator of future revenue and earnings growth, was 2.4 million as of Q1, which is up 38% year over year. Most notably, personalized subscribers grew 136% year over year to over 1.4 million, now representing 60% of the company's total subscriber base. And this reflects high consumer appetite for precision medicine across the country, which is one area that HIMS has been investing heavily in over the last few years. Encouragingly, this 60% proportion is likely to increase even further as more than 70% of new subscribers have signed up for a personalized solution in Q1. Additionally, over 80% of subscribers in men's and women's dermatology are now benefiting from a personalized offering. So I think this is an important development because personalized treatments have proven to drive a 20-point retention gain for subscribers. So with personalization, the HIMS platform becomes even more sticky, thus minimizing subscriber churn. On a quarter over quarter basis, HIMS added 137,000 new subscribers in Q1, and while that looks like a very strong number, it is actually the lowest quarterly figure in the last 5 quarters. So if you take a look at this table right here, you can see that HIMS added 137,000 new subscribers in Q1, which is much lower than the last 4 quarters, which ranges from 155,000 to 183,000. So this is quite a concern because HIMS spent more marketing dollars than ever, and yet it grew its subscriber base at a slower pace. So as you can see in Q1, the company's customer acquisition cost was a record 202 million, and as a result, CAC per new subscriber more than doubled year over year from 658 to nearly 1,500. So put simply, HIMS is spending more marketing money but drove less subscriber growth, which is not good, and this is probably the weakest part of its earnings report. However, we need to consider the fact that HIMS shifted a large portion of their marketing budget towards its weight loss business, and an example of this is the 60-second advertising campaign during the Super Bowl in February. So as a result, its marketing budget for the non-weight loss categories like dermatology, mental health, and sexual health was significantly reduced, and thus subscriber growth in these specialties were not as robust as before. Now, you might ask, since HIMS allocated more marketing dollars to the weight loss business, shouldn't the growth of weight loss subscribers compensate for the lack of growth in other specialties? Well, the answer is no, because HIMS weight loss offerings are much more expensive, probably 2 or 3 times more expensive than any other category. So naturally, subscriber conversion rates for its weight loss business are likely to be much lower than its other specialties. And so this is why new subscriber growth is much lower than the previous 4 quarters, because HIMS is focusing on growing its weight loss business. So the slowdown in subscriber growth, in my opinion, is not an issue. That is because despite lower subscriber growth in the weight loss category, each weight loss subscriber contributes to higher revenue compared to other specialties, and this can be observed with the company's monthly online revenue per average subscriber, which grew by 53% year over year to a record $84, as you can see right here. However, expect this metric to stabilize over the next few quarters as HIMS transitions off of commercially available semaglutide, which the company stopped selling recently. That being said, subscriber and revenue per subscriber growth resulted in 111% year over year growth in revenue to $586 million in Q1, which beat analyst estimates by $47 million, which I believe is the largest revenue beat since the company went public. As you can see, growth accelerated for the fourth straight quarter, and obviously, this was driven by the growing weight loss business, more specifically, its GLP-1 business. So, according to the company's 10Q filing, HIMS generated $230 million of GLP-1 revenue in Q1, which is about 40% of total revenue. So, excluding GLP-1, revenue was $356 million, up only 28% year over year. In other words, GLP-1s drove 83 percentage points of growth in the quarter. So if you take 111% minus 28%, you get 83 percentage points, which is absolutely massive. But keep in mind that there were no GLP-1 sales in Q1 last year, which is why the GLP-1 impact to growth this quarter is very large. And this is also why shorts are betting against HIMS, because they believe that growth will evaporate if HIMS is banned from selling GLP-1 drugs. But we all know that that is not going to happen. One reason for that is that HIMS offers different types of GLP-1 offerings, including branded GLP-1s like Wegovy, which the company just added through its partnership with Novo. Then there's generic GLP-1s like liraglutide, which the company recently launched in March this year. And finally, there's the HIMS and HERS branded personalized dosages of compounded semaglutide. So HIMS used to offer commercially available dosages of compounded semaglutide, but the company recently stopped selling those as the FDA announced back in February that the semaglutide shortage has been resolved. So compounders like HIMS are no longer allowed to produce and sell commercial dosages of compounded semaglutide. But fortunately, HIMS is still allowed to sell personalized dosages of compounded semaglutide, and management confirmed once again during the earnings call that HIMS will continue to offer personalized compounded semaglutide on its platform for the foreseeable future. There is the slight possibility of a GLP-1 compounding ban, but I think the chances of that happening is slim to none. That's because HIMS just announced a long-term partnership with Novo Nordisk, the developer of semaglutide, which HIMS uses for its compounded GLP-1 solutions. If they wanted to, the Novo team would have pursued a lawsuit against HIMS and pushed Congress to ban the sales of compounded semaglutide. But instead, they choose to partner with HIMS. So I think the litigation risks against HIMS is significantly reduced now that they are friends and not enemies. So moving forward, we can expect HIMS to continue to generate robust revenue from GLP-1s. In addition to that, we can also expect the oral weight loss business to continue to expand. I think a lot more people are going to transition from GLP-1 injections to weight loss pills like the one offered by HIMS, since they're basically getting about two-thirds of the weight loss as branded Wegovy for just one-third of the cost. So the price to value for its oral weight loss offering is very compelling, which is why the product is growing more than 300% year over year in Q1. So I expect this offering to continue to grow and be a much larger part of the entire company. Having said that, expect revenue growth to slow down for the remainder of 2025 as HIMS begins to face tougher year over year comps due to the anniversary of its GLP-1 offerings starting in Q2. Additionally, HIMS is still in the process of transitioning subscribers on commercially available dosages of semaglutide to other weight loss offerings, which is expected to result a one-time quarter-over-quarter revenue drop in the second quarter. After that, we can expect revenue to increase sequentially in Q3 and beyond. So with that in mind, management guided for Q2 revenue of about 530 million to 550 million, implying a year-over-year growth rate of 68% to 74%. So this missed analyst estimates of about 565 million, which is a surprise because this is probably the first time HIMS missed revenue guidance estimates. For the full year, management did not raise their full year guidance, keeping it unchanged at 2.3 billion to 2.4 billion, implying a 56% to 63% year over year growth. At the same time, they reiterated their weight loss revenue guidance of at least $725 million in 2025. But here's why I think management is sandbagging their guidance, more specifically, their weight loss revenue guidance. So, as I mentioned earlier, Q1 GLP-1 revenue was 230 million, and in the 10Q, the company actually mentioned that a significant majority came from personalized doses. And if you remember what I said, personalized dosages of compounded semaglutide are not affected by the FDA semaglutide compounding ban. Now, if we assume a significant majority of $230 million is equals to about 200 million, and assuming no sequential growth in Q2, Q3, and Q4, then we have $600 million of GLP-1 revenue for the remainder of the year. And if you add the $230 million in Q1, we get a total of about $830 million of personalized GLP-1 revenue in 2025. And this does not include Wegovy, liraglutide, and the oral offering. So the personalized GLP-1 revenue we can estimate that at $830 million, it's already higher than management's guidance of 725 million. But let's assume a more pessimistic scenario. So if we assume a significant majority is equals to 150 million, and assuming no sequential growth in Q2, Q3, and Q4, then we get 450 million of personalized GLP-1 revenue for the remainder of 2025. We add the $230 million in Q1, we get 680 million from the personalized GLP-1 business alone. Again, it does not include Wegovy, liraglutide, and the oral weight loss offering. So 680 million is already a large number, and if you add Wegovy, liraglutide, and the oral business, I think it's going to bring that number much higher than the $725 million guidance, even in the bear case scenario. So for instance, if we just look at the oral weight loss business in Q2 last year, management mentioned that the oral business had already achieved a run rate of $100 million in annual revenue. That's in Q2 last year. And during its recent earnings call, management mentioned that the oral business grew more than 300% in Q1 alone. So given management's recent comments, I think the oral business is probably at an annual run rate of about $300 million in revenue for this year. So if we add $300 million of oral weight loss business revenue to each of these scenarios, I think HIMS does at least $1 billion of weight loss revenue in 2025, which is well above its $725 million guidance. And that's again not including Wegovy and liraglutide as well. And that's not including sequential growth in Q2, Q3, and Q4, which is very unlikely in my opinion. With that being said, I believe HIMS will continue to outperform expectations in the near term, regardless of the volatility caused by the GLP-1 business. So turning to profitability, gross profit for the quarter was $431 million, up 88% year over year. Gross margin, on the other hand, was 73%, down 9 percentage points year over year, mainly due to the strength of the GLP-1 customer acquisitions and accelerated adoption of longer cadence SKUs. So as you can see, gross margin has declined for 5 straight quarters, which doesn't look good at all because it could be an early sign of a loss in pricing power. But fortunately, this decline is unlikely to persist as management expects gross margins to expand in Q2 as the company gains economies of scale and the growth of its more mature specialties contribute to margin expansion. Besides having a gross margin of 70% plus while being the lowest cost telehealth provider, to me is impressive enough. In addition, management also made it very clear that they expect gross margins to stabilize into the mid 70s level as they intend to pass on the savings to consumers in the form of lower prices. Having said that, I don't think gross margin is an important metric to look at right now, especially considering all the financial volatility that the GLP-1 business is causing currently. Instead, I'd focus on adjusted EBITDA, which was a record $91 million in Q1, which is up 182% year over year. And this represents an adjusted EBITDA margin of 16%, which was up 4 percentage points year over year. So, despite a 9 percentage point decline in gross margin, adjusted EBITDA margin improved 4 percentage points year over year, which means that HIMS drove 13 percentage points of operating leverage in Q1, which is incredible. As you can see, GAAP operating expenses as a percentage of revenue continues to decline. It was at 64% margin in Q1, down 15 percentage points year over year from 79%, fully offsetting the 9 percentage points year over year decline in gross margin. So this reflects very strong operating leverage. Most notably, HIMS is generating significant marketing leverage as marketing expenses as a percentage of revenue dropped 8 percentage points year over year from 47% to just 39% as of Q1. So as a result of operating leverage, HIMS produced $49 million of net income in Q1, which was up 345% year over year. And this represents an 8% net margin, which improved 4 percentage points year over year. And GAAP EPS was 20 cents, beating analyst estimates by 8 cents. So again, despite the decline in gross margin, HIM's bottom line continues to improve both in an absolute and marginal basis, which is what really matters. So moving forward, we can expect profitability to continue to be robust. So for Q2, management expects adjusted EBITDA to be about 65 million to 75 million, representing an adjusted EBITDA margin of 12% to 14%, which is up about 1 percentage points year over year at the midpoint. For the full year, they expect adjusted EBITDA of 295 million to 335 million, and I believe this was raised by about, I think it was about 30 million or 40 million. And this represents an adjusted EBITDA margin of 13% to 14%. So management expects margins to remain stable throughout the year. Given the company's growth momentum and operating leverage, I think management is once again sandbagging their profit guidance, and I think they will destroy their guidance as they have in the last few years. But putting their short term guidance aside, management just revealed their 5-year financial targets, which frankly came out of nowhere. So by 2030, management expects revenue of at least $6.5 billion and adjusted EBITDA of at least $1.3 billion, translating to a margin profile of about 20%. So the keywords here are at least, which is another way of saying we are confident that we will beat this guidance. Consider this. Back in 2022, management issued their 2025 financial targets of at least, there's that keyword again, at least $1.2 billion of revenue and $100 million of adjusted EBITDA. Now, guess how much HIMS is expected to report this year? So, if we look back at management's 2025 outlook, they are guiding for $2.4 billion of revenue in 2025, which is two times higher than their original guidance of 1.2 billion. And they're also expecting adjusted EBITDA of about $300 million, which is three times higher than their original guidance of $100 million. So think about it, they're about to beat their original 2025 financial guidance by twofold and threefold, which is nuts in my opinion. So I guess my point is that take this guidance with a pinch of salt, because I think HIMS will end up reporting much higher, much bigger numbers than 6.5 billion and 1.3 billion dollars. Whatever it is, I like that management have a concrete plan to get to these targets. More specifically, they will be focusing on five key growth levers. So first, they intend to deepen personalization. Given the mega trend in personalization and precision medicine, management plans to scale from hundreds to potentially thousands of treatment options, offering customers high quality, affordable, and personalized medication at their fingertips. Second, expansion into new specialties. So historically, HIMS has entered one to two new specialties per year, and the company aims to maintain this cadence over the coming years. And with its recent acquisition of Tribe Labs, an at home lab testing facility, HIMS plans to expand into low testosterone and menopausal support by the end of this year. In addition, its investment in a peptide manufacturing facility allows the company to venture into longevity, sleep, and preventative medicine over the next 5 years. Third is elevating follow up care. So HIMS plans to utilize AI tools such as MedMatch, coaches, and nutrition advice to not only automate the prescription process with a high degree of precision, but also maximize subscriber engagement and subscriber loyalty. Fourth is global expansion, and I think this is the one that got a lot of investors excited, given that there are 8 billion other people living outside in the US. Expanding into international markets will expand the company's total addressable market by at least 10x, in my opinion. Excitingly, HIMS just hired a new COO, Nader Kabani, who has nearly 20 years of global experience at Amazon, so he will help the company with its global expansion initiatives. In addition, HIMS also announced that it will be raising $870 million through a convertible notes offering, with the proceeds intended to support HIMS and Hers global expansion through organic growth and strategic acquisition. So given all these recent developments, I expect HIMS to enter a new market very, very soon. And last but not least is strategic partnerships. As you know, HIMS has established a long term partnership with Novo to combine Novo's innovative medications with HIMS and Hers ability to deliver access to quality care at scale. So, with this collaboration, I think it will open the doors for HIMS to become a major distributor of branded medication, whether it be coming from Novo or other big pharma players like Eli Lilly. And in the long run, these strategic partnerships could potentially funnel millions of patients and billions of revenue through the HIMS platform, thus supercharging growth for the company. So, in summary, lots of exciting initiatives in line for HIMS, and ultimately, I think these growth levers will transform HIMS from a small telehealth disruptor to a global healthcare powerhouse in the coming decades. Looking at the company's balance sheet, HIMS has $323 million of cash and investments, which is up $23 million quarter over quarter, with virtually zero debt on its balance sheet. And this is as of the end of Q1. So, as I mentioned earlier, HIMS just announced that they're raising $870 million via a convertible senior notes offering, which will jack up both its cash and debt levels in Q1. So keep that in mind. But it's important to note that they didn't have to do this. They didn't have to raise debt since the company has more than $300 million of cash and is already cash flow positive. So this debt offering leads me to believe that HIMS saw an opportunity and they want to capitalize on this opportunity as quickly as possible. And given all the recent new hirings and their intent to expand globally, I think that That opportunity is most likely in the form of a major acquisition, one that is located outside of the United States. In Q1, HIMS registered its highest operating cash flow ever at 109 million. However, free cash flow continued to decline as you can see right here. So Q1 free cash flow was $50 million, up 321% year over year, with margins expanding 5 percentage points year over year to about 9%. And while free cash flow improved on a year over year basis, it was down sequentially from $79 million in Q3 and $60 million in Q4. So this was due to a major increase in capital expenditures, which was 59 million in Q1, the highest quarterly figure to date. And as you can see, the intensity in capex has been ramping up over the last 2 quarters to now representing 10% of revenue, which is the highest ever. So, according to management, they are accelerating capex to expand capacity for personalized offerings, to upgrade equipment for greater automation, and to unlock sterile fulfillment capacity across its facilities. So, in other words, management is investing heavily in future growth, in building the next generation healthcare platform that will ultimately enable HIMS to more efficiently provide access to precision medicine to tens of millions of subscribers. Moving forward, I expect capex to remain elevated as management continues to invest in growth. This will pressure free cash flow margins in the short to medium term, but I have no concerns whatsoever as HIMS has a world-class management team with a proven track record of deploying capital at a high return on invested capital of more than 30% to 40%, as you can see right here. So I believe their investment will generate a ton of shareholder value in the future. Looking at the company's valuation, as you know, the stock ran up more than 100% in the last few weeks. So obviously, it's not as cheap as it was. However, I do think that HIMS is still trading at a decent value. So as it stands, HIMS is trading at a price to sales ratio of about 7 times, which is relatively inexpensive for a company that is expected to grow revenue by 60% this year. In addition, management's new long-term financial targets make HIMS look very tiny today. So here's what I mean. Assuming HIMS achieves a revenue of $7 billion by 2030 and assuming its valuation multiple is relatively unchanged at 7x, then HIMS, by my simple calculation, would have a market cap of about $50 billion by the end of 2030. So currently, as of this video, the company has a market cap of about $12 billion. So if we take the $50 billion divided by 12 billion minus 100%, we get a 5-year upside potential of more than 300%, which is probably going to destroy the return profile of the S&P 500. And this is assuming a conservative beat on management's target of $6.5 billion, as well as no valuation multiple expansion at all. With that being said, if management can achieve their 2030 target, I believe HIMS looks tiny today as compared to how big it can be in the future. Analysts are also too conservative on their estimates. For instance, analysts have an EPS estimate of 67 cents in 2025, which is only a 26% year over year growth. So, as a reminder, HIMS registered an EPS of 20 cents in Q1, which is about 80 cents annualized. And yes, EPS may come down a bit in Q2, but it should ramp back up throughout the back half of the year. So my guess is that HIMS will generate an EPS of more than 67 cents. In fact, I think it's more than likely that EPS reaches $1 in 2025, which is what analysts are expecting in 2026, as you can see right here. So I think analysts are 1 year behind on their estimates, which should lead to a valuation re-rating to the upside if HIMS happen to beat these estimates. As for me, I am keeping my 12-month base case price target relatively unchanged at $73 a share, which translates to an upside potential of about 43% based on the current price of about $50. So my assumption is that HIMS achieves a revenue of $7 billion by 2030 and then growing at a CAGR of 16% for the following 4 years, resulting in a revenue of $12.6 billion by 2034. For free cash flow margin, I expect it to be 20%, which might be too conservative given all the operating leverage that the company is experiencing currently. So, for context, the company's trailing 12-month free cash flow margin is about 13%. So a 20% long-term free cash flow margin is I believe is just not too much to ask. And with a perpetual growth rate of 3% and an aggressive discount rate of 12%, I get a base case price target of about $73 a share. And that's the base case, which I think is a bit too conservative, but I like to be conservative. Given all the new initiatives like category expansion, peptide innovation, and global expansion, I think the bull case is a real possibility, which gives me a price target of $111 a share, representing an upside potential of about 117%. However, given the recent parabolic move over the last few weeks, I do expect a pullback probably to $40 or worst case $35. But over the long run, I expect the stock price to advance higher as it continues to track its improving fundamentals. So, some major catalysts to take note of are a possible partnership with another big pharma player like Eli Lilly. We already saw what happened when HIMS announced the Novo partnership. So, a Lilly partnership could definitely push the stock price higher. Also, Mark Cuban will be joining the HIMS House podcast on May 12th, I believe, which could bring a lot of buzz among investors. Other catalysts include new market expansion, new specialties, and other positive news that could trigger a short squeeze as the company has a high short ratio of over 30%. So, wrapping up this video, HIMS just reported its best quarter ever with massive beats on both revenue and EPS estimates. The company continues to grow its subscriber base, and most notably, personalized subscribers were up a whopping 136% year over year. Profitability continues to improve as well, with adjusted EBITDA margins expanding to new highs, even despite a decline in gross margins, signifying strong operating leverage within the business. Excitingly, HIM still has a massive growth runway ahead, supported by megatrends in AI, telehealth, and precision medicine. And this is why management is investing heavily in building the next generation healthcare platform. Additionally, HIMS has landed a long term partnership with Novo, which essentially removes litigation risks against HIMS. But above all, the partnership put HIMS on the healthcare map. And speaking of maps, HIMS is also planning to expand globally, which should accelerate the company's growth for years to come. With that, management laid out their long term financial targets, expecting 2030 revenue of at least $6.5 billion. I think this is a sandbag figure, so this should leave a lot of room for a surprise to the upside. More importantly, management's 2030 financial targets, in my opinion, make the company's valuation look like peanuts, thus offering plenty of upside for long term investors. With that, I believe HIM stock is still undervalued, even considering the recent rally. My price target is about $73 over the next 12 months, with the potential to reach $111 in the bull case. With that being said, thank you guys so much for watching this video. If you enjoyed it, please leave a like, share it, and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys in the next video.